Hello friends, welcome to learning sessions and today in this video we are going to discuss about the rest of the part from the chapter number 24, that's capital structure and the cost of capital. We have already covered a part related to the capital structure and cost of capital. I told you capital structure is like a composition of debt and equity, and further we discussed NOI, that is net operating income approach, that is a NOI approach, and further we also discuss the NIA approach, that is net income approach, right? Both are given by the David Durant, right? So we discussed all the fundas about it, and now we are going to cover about the taxation and the capital structure first of all. So do confirm the audio video quality so that we can be proceeding. And this is class number 27 for the accounting and financial management for bankers. So if you have not gone through the previous sessions, make sure to download the application right away through the link iibf.info/app and use it. You can get all the session and start your preparations right away, right? So it's covering the full course videos, it's covering the case study videos, it's covering the previous set questions, mock test, mega test, and the PDFs are also available which are downloadable and printable. So do download the application right now and start your preparations, or simply you can be downloading, or simply you can be WhatsApp 609 you with all the details. Okay, working all fine now. The audio video quality is working all fine. So let's start the session. It's about the taxation and the capital structure. It's about the taxation and the capital structure. Okay, so I told you about it when we are to determine the firm's capital structure. It's about the composition of debt or equity. So either will be having the debt component more or the equity component more, or both could be all same. And when we are using the much more component of the debt, we say the company is geared or it is leveraged, right? And what's basically having the more cost toward it? The debt is having the more cost or the equity is having the more cost? The debt is having the cost, like we are to pay the interest to the persons, right? But equity is concerning the cost with the dividend, because we are to give a particular dividend to the persons who are basically have given the equity toward us. And also it's about that we are to give a performance related to it. So equity is more serious than we consider the debt is. Okay, and we need to understand the term EBIT. We need to understand the term EBIT. Now, what is EBIT? It is earning before interest and taxes. EBIT is earning before interest and taxes, means even before the tax has been imposed, right? So it's basically the operating profit. So it's simply we can say EBIT is what? EBIT is the operating profit of the company, operating profit of the firm, but before deducting the interest expenses, before deducting the income tax. Okay, so it basically reflects the profit which is purely generated from the core business operations. Purely generated from the core business operations, we are talking about that. So let's have a look at this particular example. It says XYZ Limited having total capital of rupees 2 lakh, has EBIT of rupees 1 lakh for the year. Corporate tax is 25%. Rate of interest on debt is 12%. Let us consider the following three scenarios. So we are considering three scenarios. In the first case, we are having 100% of the debt and 0% of the equity. In the second scenario, we are having 50% of debt, 50% of equity. And in the third case, we are having the 0% of debt and 100% of the equity. And 100% of the equity. Now let's have a look at the different scenarios over here. So EBIT is all same. We are having the same EBIT of rupees 1 lakh. So it's purely reflecting the amount generated from the core business activity, which is 1 lakh rupees in each and every case. And the second scenario we are considering, that we are having the composition of debt like 100%. Here we are having the debt as 100%. In the second scenario, we are having the debt at 50%, equity at 50%. And in the third scenario, we are having the equity at 100% and zero debt. And the zero debt is there. And also it is mentioned that the total capital of rupees 2 lakh is there. So we are in the first scenario, we are considering rupees 2 lakh of the debt. In the second scenario, 1 lakh of the debt. And in the third scenario, no debt is there. And if we look at the capital base or equity capital, we are having zero capital equity in the first scenario, 50% equity in the second scenario, and 100% equity in the third scenario. And the interest is given to be 12%. And so interest will be charged on the debt component only. So 12% of 2 lakh rupees, 24,000, 12% of 1 lakh rupees, 12,000, and 12% of 0 rupees is basically zero. So what will be the PBT? What will be the profit before tax? So it will be EBIT minus the interest. EBIT minus the interest, that is EBIT. So if we name it A and interest as component B, we can say PBT would be A minus B, right? So it is to 76,000, 88,000 and 1 lakh rupees. And further, the corporate tax is to be imposed at 25%. The tax is 25%. So it is the C component. So 25% of the profit before tax. So upon what the tax is imposed, so we can say if it is D, and further if it is C, so tax is to be imposed on C. The tax is to be imposed upon C. So 25% of 76,000, 19,000, 25% of 88,000, that is 22,000, and 25% of 1 lakh rupees, that is 25,000. Now what is profit after tax? We are to deduct the taxes also. So D, we can simply be saying C minus D. C minus D, that is your profit after tax. That is 76,000 minus 19,000, that is 57,000, 66,000, and further 75,000 and 75,000. So the total income on both debt and equity capital is what? What would be the total income on both debt and equity component? It is simply 81,000 rupees. In this scenario, it is 81,000 rupees. Means we are talking about the E and further about the B. E plus B or B plus E we are talking about. So it is 81,000 in first case, 78,000 in the second case, and 75,000 rupees in the third scenario, and 75,000 rupees in third scenario. Why we are doing so? Because we were to talk about the total income, total income on debt and the equity capital. So what was the total income on debt? It was basically 20 it was basically what? It was basically 24,000. And further, if we talk about the equity, it is 57,000, right? So that's it. So if we look at the combined income on debt and equity capital, that's going to increase as the leverage of the firm increases. So more is the debt component, more is the income, because 100% tax exemption is provided. Now, whatsoever the tax was imposed, that was imposed after deducting the interest component, not on the interest component, right? So combined income of the debt and equity, if we say, that basically gives more leverage to the company, because 100% of the tax exemption is provided under the IT rules on interest paid on the debt. So whatsoever the interest is paid on the debt, there is 100% tax exemption. Clear with it? Kindly confirm at the earliest that if you have understood this particular part. Now, this is very much basic but very much important part so as to understand. We should be understanding the basics about it. It's very much important so as to understand the basics about it. Okay. Now, let's learn about after that about the concept of cost of capital. The cost of capital concept. Now, again, this is very much important. The most important concept under this particular chapter, we can say, it's about the cost of capital. Now, cost of capital is basically the minimum required rate of return, or we can say MRR, minimum required return, right? That the company must be earning on its investment so as to maintain the value of the securities, so as to satisfy the investors. Satisfy the investors means we are having the equity holders, we are having the debt holders. So we have to satisfy that also, right? So the concept of cost of capital is, it's basically representing what? It is representing the opportunity cost of funds. It is representing the opportunity cost of funds, that the minimum return that we must be providing at least so as to maintain the market value of the securities. So first thing it's related that we have to maintain the market value of the securities. Second thing it's related that we are to provide the required return to the equity holders and the debt holders. And why it is important? Because this is a very much basis of the capital budgeting decision. Capital budgeting decision, that what project is to be selected, what project is not to be selected. Because if the cost of capital is more, then definitely we won't be selected that particular project which is having more cost of capital. It also basically is used in NPV method, that is net present value method, that will be covering in the next chapter. So definitely it's going to be used over there also. It's used in the valuation models also. So let's say if you're having the project return, just consider that we are having the project return which is greater than or equal to cost of capital. Cost of capital greater than or equal to cost of capital. The decision would be related to that we are going to accept that project, right? And let's say if the project return we are talking about, return on the project return we are talking about, if it is lesser than that of the cost of capital, then why would we accepting the project? Now, if it's basically loss making, we are not able to earn a part of it, then we will be rejecting it. Then we will be rejecting it. Now we are having the different components under the cost of capital. So it's about the components of cost of capital. Now you know that what is cost of capital, right? We are to maintain the market value of the securities. We are to give a return to the debt holders. We are to give a return to the equity holders. Now, after that, it's about the components of the cost of capital. The first component, it's basically the cost of equity. It's about the cost of equity. The second, it's about the cost of debt. And the third one, it's about the cost of preference capital. Cost of preference capital. Or it could also be the retained earnings or something like that. Clear with it? So these are the components of cost of capital. First one, we are going to learn about the cost of debt capital. The first component that we are going to study, it's basically related to the cost of the debt capital. So whatsoever the debt we are having as a firm, we have to pay a cost toward it, which is basically represented by KD. It is represented by the component KD. And this is the effective rate of return that the company is to pay on the borrowed funds. Now, whatsoever the funds that the company has borrowed, let's say the term loan that you are having, debentures, bonds that you have issued, or bank borrowings are there, you have to pay a return to the lenders. You have to pay a return to the lender. That is it. That is a major part related to it. So it's the interest rate that the company is required to pay in order to raise the debt capital. And interest paid is what it is representing the cost. It is representing what? It is representing the cost that we have to pay. And for bonds and debentures, we are to pay the coupon. For bonds and debenture, we have already learned about it, that we are to pay the coupon to the bond holders, debenture holders, and also there exists a secondary market. There is a secondary market for the bonds and debentures also. So the interest rates are increasing, the bond value will be going down. So that there also the investors are expecting a return out of it. There are also return the investors are expecting out of it. So that's about the cost of the debt capital. That's about the cost of the debt capital. Clear with it? Is that part clear to you? That's about the cost of the debt capital. And the approximate YTM, the yield till maturity, can be calculated by the following formula. So we may to use this particular formula if we are to calculate the approximate YTM for the given particular concept. We'll also be solving a numerical about it, very simple numerical about it, but we are to memorize this particular formula. So YTM is equal to what? YTM is equal to annual interest payment that we are to make. the annual interest payment that we have to make. We are talking about the coupon here, right? Plus MV is basically the maturity value. PV is the present market value. This is not the present value, but this is a present market value. N is basically the number of years, or we can say residual maturity. Residual maturity, we can say. So N is representing what? This is the residual maturity we are talking about. Clear with it? So this is the formula, divided by 0.6 into the present value plus 0.4 into the maturity value. Okay, so this is the formula related to it. How we can be memorizing? First of all, it's about the coupon. It's about the coupon plus the maturity value minus present value divided by n, and further 0.6 into the present value plus 0.4 into the maturity value. This is the formula related to the YTM, the approximate YTM. Okay, now let's solve a numerical based upon it. So it says a firm's debentures with face value of rupees 100 and coupon of 10% are having a current market price of 90, and that is a current market price, or we can say the uh, present value, PV, we can say this is PV, right? And further, the number of the years left to maturity, that is N, that is given to be 4 years. What is the cost of debt capital for the firm? So now we have to calculate the cost of debt capital to the firm. How we can be calculating? We have to calculate the expected YTM that is to be paid, approximate YTM that is to be paid. And the formula is just mentioned above. We just mentioned the formula. First it was coupon. Now coupon is 10% on rupees 100 face value. That is 10 over here, plus the market value. The market value, right? And what is the market value? That is a, what is the formula for the that particular case? That was the market maturity value, not market value, sorry, maturity value. Maturity value means the value that we'll be getting at the end of the maturity. That's face value we get. So it is 100 rupees minus the present market value, that is the PV, that is 90 rupees it is given to be, divided by the number of years residual maturity, that is 4, and further divided by 0.6 into the present value, that is 90, plus 0.4 into the maturity value, that is 100. Now we need to solve this. So 100 minus 90, that is 10 divided by 4, that is 2.5. So 12.5 divided by 5.4 plus 4, that is 9.4. So that comes out to be 13.30%. It is coming out to be 13.30%. Clear with it? Do confirm at the earliest if you have understood so far. So using this particular formula, we can be calculating the cost of debt capital. Cost of debt capital. Now after that, it's about the cost of the preference capital. It's about the cost of the preference capital. Now what is preference capital? Where we give a preference to the equity holders that they will be receiving a sure dividend. That they are assured that will be receiving a dividend related to it, and it is represented by KP. It is represented by KP. This is a cost of preference capital, and further this is a rate of return that is required to be paid to the preference shareholders. Now they have invested funds and they basically do require a minimum return to be paid, because to them a fixed dividend is paid. A fixed dividend is paid. In general, we talk, when we're talking about the preference capital, we say a fixed dividend is paid, and much more priorities to them as we compare to the equity shareholders. So they are paid dividend in priority, but they do not get the voting rights. In general, if we talk about, they do not get the voting rights. And whatsoever the dividend on the preference share is paid, that is non-tax deductible. So no tax shield benefit is available to them. No tax shield, that is non-tax deductible, no tax shield benefit is available on the dividend which is paid on the preference shares. On the preference shares. So preference capital carries a fixed rate of interest, which we say to be dividend, that is to be paid to the preference shareholders, like, let's say, because that's the major part that we need to pay only, right? But higher risk perception is there. Kindly take a note. In case of equity, always and always there is a higher risk perception as it comes after the secured creditors. Just after the secured creditors, the next component that we have to pay off in case of liquidation, it's about the preference shareholders. And the interest paid is also not tax deductible. No tax is to be deducted on the interest which we have paid. Like we consider the case of the debt. Now, whatsoever the debt interest was paid, the tax was basically not deductible for that. The interest paid in case of the preference capital, also the tax is not deductible, right? So as in the case of the debentures, the approximate cost of preference capital is used by using the formula like this, the same formula. The same formula can be used like that we used in the case of the debt capital. The same formula of the writing can be used. Annual interest payment means the dividend we are paying, that will be here. And M is basically what? M is representing the maturity value and P is representing the present value divided by the residual maturity, and further uh, 0.6 into P and 0.4 into M. The same formula can be used. But there is an assumption that a fixed dividend will be paid each and every year. Fixed dividend will be paid each and every year. And the second assumption is related to, this is the first assumption, that the fixed dividend will be paid. And the second assumption is related to that the preference shares will be redeemed on the due date. That whatsoever the preference shares are there, those will be redeemed on the due date. So using that particular thing, we can also be solving a numerical. The same formula is to be used. So nothing to be worrying about. Nothing to be worrying about. Clear with it? So even if we are talking about the cost of debt or we are talking about the cost of the preference capital, it's the one and the same thing. So if you have understood the topic so far, do give this video a like and share. So if you have understood the topic so far, do give this a video a like and share. If you want to get the PDF and all the previous PDFs, chapter-wise previous questions, case studies, make sure to download the application, which is available at the link iibf.info/app. Just use this link so as to download the application and use the ORG code when if it is the iOS you are using. So it will be asking for the ORG code, which is GEGKT. So let's now move ahead. It's about the cost of equity capital. Cost of equity capital. Now the company also pays a return to the equity holders. A return is paid to the equity holders also. That is represented by KE. So that is the cost of equity capital, the rate of return which is required by the equity shareholders. Now, equity shareholders have also invested amount to it, right? So definitely they also want to get the money out of it. They want to make money out of it, right? So that's basically the opportunity cost of the equity funds. Opportunity cost of the equity funds. But like we talked about the debt and the preference equity, the dividend is not compulsory here. Dividend is not compulsory, first of all. And secondly, not tax deductible, and further the dividend is dependent upon profitability. That is dependent on the profitability. Clear with it? And we are having the different approaches so as to estimate the cost of equity capital. These are the four different approaches we are having. Four different approaches we are having. One, it is a CAPM approach. This is very much important topic, right? So one, it is CAPM approach. Second one, it is bond yield plus risk premium approach. Third one, it is the dividend growth model approach. And the fourth one, it is earning price ratio approach. These are the four approaches which are used. The first approach that we are going to learn about, it's about the CAPM. It's about the CAPM approach. Now, what is CAPM? It is capital asset pricing model. Capital asset pricing model. Now, as per this particular approach, what's the required rate of return on equity? Let's the minimum cost that is to be paid to the investor of the equity shareholder. Minimum return, we can say. Minimum return, whatsoever is to be paid to the equity shareholder, that basically depending upon three factors. So we are talking about the factors based upon which the minimum return is to be paid. And what are those factors? One, it is a risk-free rate of return. That if the return is to be paid without any risk, because the risk is being taken. So first of all, we need to consider the rate of return which was risk-free, right? We say to be RRF or risk-free return, simply RF also we can say it. So we say to be RRF, risk-free return. Second thing, it's about the beta factor, the second factor, it's the beta factor. We basically say to be beta A. Beta A. Why it's beta A? Because it is describing, it is basically letting us know about the movement of the stock in relation to that of the market. So beta is representing what? That how the stock price is moving to of our company in relation to the overall market. So let's say overall market is basically Sensex, and further our stock price is moving, right? So will be the beta factor will be representing that how our company share price is moving as compared to that of the complete market. Clear? And the third factor, it's about the expected return on the portfolio of equity shares. It's about the expected return on portfolio shares. So what people are basically having the perception related to portfolio return, that will be the third factor. So we are having the three factors. One, it is a risk-free return. Second, it is a beta factor. The third one, it is a portfolio return, the minimum return that we are expecting. We can say it to be RM. We say it to be RM. That is expected return here. Expected return here. Okay. And expected return on security, that is represented by RA. We say to be overall expected return, considering all these factors on security. Expected return on security, that would be equivalent to what? That would be, that is said to be RA, and that is equal to risk-free return, that is RRF plus beta A, and multiplied by RM minus RRF. So this particular factor, that is RM RRF, this is the equity market premium. This is what? This is the equity market premium. The premium that we have to pay above the risk-free return, right? That is equity market premium. And it may be the case that you're not provided with RM, you're just simply provided with this term in the numerical, right? So we have to use it that particular manner. So this is the formula. So this is the formula that we need to use. RA is what? This is expected return on the security. This is what we need to use. Clear with it? Kindly confirm at the earliest that if you have learned so far. So this is a CAPM approach. This is the CAPM approach, right? So we do consider three factors. Let me just reiterate these three factors. One, it is related to the risk-free return. Second, it is a beta of the company market share. And third one, it is prevailing expected return on the portfolio. And here we are having the formula related to the RA. This is to be used. Clear? And further, RA is representing the expected return on equity. The RRF is basically risk-free return, rate of return. RM is representing the expected return on the market, and beta is the beta of the security, and RM minus RRF is representing the equity market premium. Clear? Let's have a look at this particular question. Here we are having this question. The risk-free return is given, and it is given to be 12%. The risk-free return means we are provided with RRF. RRF, it is given to be 12%. Further, the expected return on the market portfolio, it is 16%. On market portfolio means we are talking about the RM. It is 16%. And further, what will be the required rate of return on company equity capital, which has a beta of 1.5. So beta factor is given to be 1.5. So simple, we can solve it. So it will be equal to what? It will be equivalent to risk-free return, that is 12 plus 1.5, and for the 16 minus 12. That's it. That we need to solve. 16 minus 12 is 4. 4 into 1.5, that is 6, plus 12, that is 18. So the expected return on security will be 18% in this scenario. Clear? So this is how we can be solving the numerical related to it. After that, it's about the second method that we are going to learn about. That's the bond yield plus risk premium approach for the cost of equity. Bond yield plus risk premium approach. So equity risk premium is just added to the yield. Whatsoever the equity risk was there, equity risk premium is there. That is basically added to the yield on the long-term bonds of the firm. So let's say the long-term yield on the firm bond of the firms is 12% and the equity risk premium is 4%. So we'll be just be adding toward it. That's it. This is a simple formula related to it. This is a simple formula related to it. And this is simply bond yield plus the risk premium. So it basically adds a equity risk premium to the company's long-term debt cost. So if your long-term debt cost is given to be, let's say 13% and the risk premium is given to be 4%, what is your cost of equity? It is simply 17%. Because bond yield plus risk premium approach simply says what are the bond yield you are getting plus the equity premium that you are approaching for. Just add those 2 points. So it's very simple and practical method, and it is used for the unlisted companies. It is used for the unlisted companies. The third one, it is a dividend growth model, or we say it to be the DGM approach. We say it to be the DGM approach. This is also called Gordon growth model. We also know it for one other name, that is Gordon growth model, right? This is a Gordon growth model. And what is the formula related to it? This is D1 divided by P0 plus G. Formula. It is KE is represented by D1 divided by P0 plus G. This is the formula. Now D1 is basically expected dividend next year. What dividend you are expecting another year, next year? That is a dividend. And P0 is representing the current market price. Current market price. And G is basically the growth rate. G is the growth rate related to it. G is the growth rate related to it. So if we are considering, it is P0 divided by G, sorry. It is P0 divided by D1 plus G. So if we know that what dividend is to be paid for the first year and what is the present value, we can easily be calculating using this approach. So present value of the face value of 10 rupees, equity shares of the firm is 100 rupees, and present value is 10 rupees, and equity share of firm rupees 100 rupees. Dividend is expected in the first year is 10%, and the expected growth rate is 4%. And what will be the required rate of return on the firm's equity capital? So it is present value. Present value is 100 rupees. It says present value of 10 rupees face value. So we are not considered 10 rupees value over here. We have to consider the present value, which is 100. Dividend is 10%. Dividend is what? Dividend is 10%. So it is basically the 10% plus 4% is the growth rate. So this will be the answer. So it will be 14%. It will be the 14%. So we have learned three approaches so far. One, it was related to the CAPM, capital asset pricing model. Second, it is bond yield plus risk premium approach. Third one, it is DGM, that is dividend growth model approach. And the fourth one that we are going to learn is earning price ratio approach. It is earning price ratio approach, or EP approach we say. So what is the formula? This is expected EPS for the next year divided by the present market value of the share. Divided by the present market value of the share. Now, what is EPS? EPS, I've already given an idea to you related to EPS. It is earning price share, earning price, earnings per share. Or let's say it is representing the portion of the company's net profit attributable to the each equity share. To the each equity share. So we can say simply the net profit after tax, EPS. It may be the case that the direct EPS is not given to you in the question. We have also solved it under the ratio analysis chapter. So it is net profit after tax, or simply the net profit if it is given, right? Divided by the number of equity outstanding shares, number of equity shares, number of equity shares that are floating in the market. That is basically your earning price ratio approach. Earning price ratio approach. So what will be the required rate of return? That will be the expected EPS for the next year divided by the present market value of the share. So in the question it is given, if the present market value of the equity share of the firm is rupees 100, present market value of the equity share, that is the denominator, that is given to be 100, and the EPS for the next year is expected to be 15 rupees. So we can be easily be calculating the required rate of return, that is KE, can easily be calculated. So in a nutshell, we can say, if we are to calculate, so this is the fourth approach. The third one was related to DGM approach. DGM approach. What was the formula for DGM? Very easy. Present value divided by the dividend for the first year plus the growth rate. That was the formula. And if we are to talk about the CAPM approach, or let's say about the bond yield plus risk premium, bond yield plus risk premium, what was the formula? Simple, bond yield plus risk premium. And further about the CAPM, approach, what was the formula? It was RA is equal to RRF plus beta, and for the RM minus RRF. That was the formula, right? So these are the four approaches related to calculation of the cost of equity. Clear with it? The next one that we are going to learn about, it's about the weighted average cost of capital. It's about the weighted average cost of capital. Now, weighted average cost of capital is the overall average cost. Let's say we are having the funds from the different sources. We are having the funds from the debt, funds from the preference capital, funds from the equity capital. Now we are to calculate the weighted average cost of all the funds. So it represents the minimum required rate of return that the company must be earning so as to satisfy the providers of the capital. So to satisfy the providers of the capital. Clear? So this is the weighted average cost of capital. Weighted average cost of capital. So the capital structure of the firm is given to be like equity capital 40%, preference capital 10%, debt capital 50%. The cost of each is estimated as under, like equity capital cost is 20%, preference capital 15%, debt capital 10%. Now the composition is given. So here we are given about the composition. And here we are given about the cost, right? So we have to calculate the WACC. So what we do actually, we keep the cost as it is, and we do represent the proportion in decimal parts, right? So it is 20 into 20 is the cost into proportion, 40% means 0.4, 15% is the cost for the preference capital into 10% composition, that is 0.1, and 10% is the cost for the debt capital, and for the 0.5 is the composition. So we just calculate the WCC, it is coming out to be 14.5. So we are having the three components related to it. We are having the three components related to it. The another alternate formula for the WACC, weighted average cost of capital, it is what it is: E divided by V multiplied by KE, cost of equity, plus D divided by V into KD, the cost of debt, and further it is to multiply further by 1 minus T. I'll be explaining the things to you. Plus the third one, it's the P divided by V and multiplied by the KP, that is for the preference capital cost. Now E is the market value of equity. E is the market value of equity, and further D is the market value of the debt. So E is the market value of equity, D is the market value of the debt, and further P is representing the market value of the preference capital, and V is the total capital. V is the total capital, means V is equal to E plus D plus P. V is equal to total capital. Total capital value we can say. KE is the cost of equity, KD is the cost of debt, and KP is the cost of preference capital, and T is the tax rate. T is the tax rate. So this is a formula related to the WACC. This is also the formula related to the WACC. Now, what factors are going to affect the value of the WACC? What factors are going to impact the value of WACC? There are internal factors and there are external factors. There are internal factors as well as there are the external factors. Internal factors, we can say the capital structure policy. Like what should be the capital structure? What should be the debt component? What is the equity component? What is the preference share component? That's basically related to it. And capital investment policy, that where you want to basically invest, and also the dividend policy, that how the dividend is to be paid, what minimum amount of the dividend is to be paid. That's the policy that's going to basically affect the WACC, because that's going to change, alter your overall cost. And there could be the external factors also. There could be the external factors also, like we are having the prevailing interest rates in the market, the risk perception that we need to cater. At least, like if the market is perceiving more risk with your firm, we have to pay more cost, because more is the risk, more is the interest that we need to pay, right? More is the cost that we need to pay. So that's market risk perception, market risk premium perception, and rates of corporate and the personal taxes. These are the external factors. So some of them are the internal factors, like your capital structure policy, capital investment policy, dividend policy, and external factors like interest rates, market premiums, and the corporate taxes, personal taxes. That's the thing. Okay. And moreover, if we look at the weighted marginal cost of capital, weighted marginal cost of capital, the rate of return which is required by the investors tends to increase as more capital is raised by the firm, because more leverage will be there. So more is the leverage, more is the leverage, more higher will be the cost. Simply we can say more cost will be there, because people will be perceiving that this company is on the debt rails, and it may be more riskier. And this concept is said to be the marginal cost of capital. This is said to be the marginal cost of capital. So let's say if the capital structure of the firm is consisting debt of 100 lakh rupees, let's say it is able to, raise that particular debt at 10%. But let's say if the company is raising 200 lakh rupees, the interest cost may increase. Let's say it may be increased 10 to above 10% to 11% or 12% or something like that. Further after that, it's about the optimal capital structure. Optimal capital structure means perfect mix of debt and equity financing. The perfect capital mix of the debt and equity financing that is going to help us, that we can be maximizing the value of the company, and further we can be minimizing the cost of capital. We can be minimizing the cost of capital and maximizing the value. Clear with it? So that's about the chapter number 24. I hope that you must have understood the complete part related to it. The next topic or the next chapter that we are going to cover it's about the capital investment decisions and the term loan, that what particular project is to be taken and what project is not to be taken, how it is to be selected, what rules should be there, everything about it. So do confirm that if you have understood the previous part so far, do like the video and do share the video at the earliest. And if you're having any doubts related to it, do post in the comment section. So the next chapter, it's about the chapter number 25. So this is a chapter number 25 that we are going to cover now from the module C. So it is about the module C, chapter number 25, right? And the concept is very much important. These concepts are going to be very much important from the exam point of view, right? So this is related to capital investment and the decisions and term loans. Now, what is investment appraisals? Investment appraisal is just the techniques that we are going to appraise, the techniques that we are going to use. Those are being used by the firms, by the investors, primarily so as to determine that what particular investment will be profit making, right? Which particular investment will be profit making. So this investment is going to make profit for us or not. That's about the appraisal of the investment. And we are having the different approaches, like we are having the discounted methods, we are having the non-discounted methods also. Discounted methods, we are to discount the cash flows to the present value. We are to discount the cash flows to the present value. That is a discounted method. And when we do not discount the values, when we do not consider the time value of money, that is considered to be non-discounted methods or non-DCF method. So one, it is the discounted cash flow methods, or it is the non-DCF methods, or it is a non-DCF methods, right? So first one, we are going to cover about the discounted cash flow methods. Discounted cash flow, as we consider, we are to discount the values through the discounting factor, through the discounting rate. So whatsoever the cash inflows and cash outflows are going to be there, those are to be discounted. Only after that, that is to be compared. And basically, we do consider the time value of money. We are to consider the time value of money when we are talking about the discounting cash flow methods. And we are having the two approaches here. One, it is a net present value, NPV method. Second one, it is a internal rate of return, that is IRR method, right? So the one approach, it is a net present value. The second one, it is a internal rate of return approach. So we are going to cover the NPV method first of all. This is very much important topic, very much important. Definitely you can be finding a question about it or even more about it in the exam. So it's about the NPV method. So what actually happens? So let me just draw a timeline. So let's take the case that you are having the timeline over here 0, 1, 2, 3, 4, 4 years timeline. And let's say we initially invested the amount of rupees 80,000. So I'm putting a negative sign beside it. Negative side basically means that this is a cash outflow, right? On the day zero, we're having the cash outflow of 80,000 rupees. And further, there was a cash inflow of 30,000 for the first year, of 13,000 on the second year, 30,000 again on the third year, and further, let's say 20,000 on the fourth year end, right? So these are representing, these in black in representing what? These are representing the cash inflows, and in the purple one, it's representing the cash outflow. Now we are to consider the time value of money. Like we basically discounted the value of the coupons that we received in the case of the bond. We discounted those values using the discounting factor, na? So the discounting factor formula is 1 divided by 1 plus r raised to power n. So we have to discount all these values. Means the first value would be minus 80,000. This is to be discounted. So this cash flow of 80,000 will be multiplied with the discounting factor. And for this case, let's say consider the discounting rate to be 10%. We are considering discounting rate, which is represented by small r, to be 10%. So it will be 1.10 for the year 0. It will be 0 plus for the second year we are getting the cash flow of 30,000. It is a cash inflow of 30,000 divided by 1.1 raised to power n 1 plus for the second year we're getting 13,000. So we are to take care of the signs also. For the cash inflow, it's a positive sign, and for the cash outflow, it's a negative sign here, right? So for the second year, it is 13,000 divided by 1.1 raised to power 2 plus for the third year, again, it is 30,000. So it is 30,000 divided by 1.1 raised to power 3 plus for the fourth year, that's the last year, it's 20,000 divided by 1.1 raised to power 4. Now, if we try to solve this, we'll be solving the NPV, net present value, because NPV is just related to, we are to calculate the present value of all the cash inflows and outflows, right? That's it. That's the algebraic sum of present value of all the cash inflows and outflows, that is representing the NPV, that is a net present value. So 80,000 would be as it is because it is raised to power 0 in the denominator. So it is 80,000 negative as it is plus 30,000 divided by 1.1, that is 27,272. So the amount is 27 reduced to 27,272 plus for the third year it is 13, for the second year it is 13,000 divided by 1.1, that is 10,743. 10,743. And for the third year it is 30,000 divided by 1.1, that is 22,539. The value is reduced, 30,000 is reduced to 22,539. Discounting means we are considering the time value of money. And the last one, 20,000 divided by, so it is coming out to be 13,660. Now, if we just take the algebraic sum of all these terms, so it will be 27,272 plus 10743 plus 22,539 plus 13,660. That is 74,214 minus 80,000. So it is negative of 5,786. It is negative of 5,786. Now, how come this is going to be beneficial for us? How can we be evaluating that we should be going for the particular project or not? Now, just look at the factor. Now, whatsoever the value that we invested and whatsoever the value we got, we calculated the algebraic sum of the present value. Algebraic sum of present value. Now, if this value was positive, it means NPV is positive and we are to accept that particular project because it is going to be profitable. It's going to be profitable. But if NPV is negative, it means we should not be considering the project. We should not be considering the project because the present value is not even able to cover the present value of the cash outflows. The present value of inflows is not even able to cover the present value of the cash outflows. So we should not be considering that particular project. That is what it indicates. So if NPV is positive, it's very good project. Do take it. If NPV is negative, just don't go for the project. If NPV is 0, then it is indifferent decision. No profit, no loss situation. Clear with it? So what are the different stages involved? It's estimating the all future cash outflows, convert the cash outflows or inflows into the equivalent present value, add all the values algebraically, and that's it. So NPV is algebraic sum of all the cash inflows and outflows. And this is what we just did. So this denominator is representing the discounting factor and the term above in the numerator is representing the cash flow. And I is basically the initial investment. And it says the same that if NPV is positive, do undertake the project. And if it is negative, do reject the project. Do reject the project. So have a look over here. So we are having the two projects, project A and project B. We are having the cash inflow, initial investment of 2,000 in the first case, 1,500 in the second case. And these are the cash inflows over the 6 years period. So it is 350, 500, 600, 800, 800, 600. And the second scenario also the 200, 260, 450, 700, 700, 400. And also the discounting rate is given to be 10%, means R is given to be 10%. And when we are to calculate the discounting factor, the second column here, the discounting factor, it is calculating the discounting factor as the 1 divided by 1 plus R raised to power n. 1 plus R raised to power n. So n will be 0 here, 1 here, 2 here, 3, 4, 5, and 6. So we calculated these discounting factor using this particular discounting factor formula, right? We just multiplied the column A with the column B so as to calculate the present value. So it is A into B so as to calculate the present value. And we added up them all and we got the NPV positive 564 in the project A and positive 373 in the project B. Now, if we do compare the NPV of the project A and B, both are positive. Both are positive. But project A is having much more positive NPV as compared to the project B NPV. So definitely we should be going ahead with the project A. We should be going ahead with the project A. But there are some limitations related to it. What is the limitation? First of all, limitation related to that we are to assume the discounting rate and it is difficult and it may not be appropriate, right? So this is the first limitation. The second thing it's related to the different projects are not comparable if those are of not same time period. So if the timeline is different, let's say one project is for 4 years, the other project is for 10 years, we are not going to make a decision about it. And there are multiple assumptions about the cash inflows. You do assume the cash inflows, cash outflows, and definitely it may be the case that there may be so much expenditure on the surface which is not right now, like we are not able to justify that, right? So that can be the case. So that will be all about this particular video. If you have understood the concept so far, make sure to like this video and further share this video among your friends and colleagues who are preparing for the JAIIB exams. The JAIIB exam dates have already been announced. Make sure to register in time and further do download the application from the above link, that is iibf.info/app. Use the ORG code GEGKT and start your preparations right away. Thank you so much and see you again in the next video. Happy learning.